Hey everyone, it's Wei Ming here, and in this short video, I'll be explaining what is institutional ownership and how do I use it to help me select stocks. So when we talk about institutional funds, right, we are actually referring to those very big, large hedge funds. Like think about your Warren Buffett and all the very big hedge funds managers, right? So what I'm looking to do is I want to see this company that I'm looking at, for example, Apple or Visa, my favorite companies, right? Um, these big players like Warren Buffett, do they actually invest in these companies? And why is that important for me, right? Because I'm looking at it as a form of safety net. Because I know that these large institutional funds, these large hedge funds, right? If they also invest in my favorite company, let's say Visa, for example, what does that mean? These hedge funds, do you think they will have a better data and research than us? For sure, right? So there is what we call smart money involvement. This hedge fund, let's say Warren Buffett, right? Do you before he invests in a certain company, his favorite company, Coca-Cola, Apple, so and so forth, right? He will definitely spend a lot of time researching on this company before putting his money in it. Because when he put his money, it's not a bit of money, right? It's like millions and billions of dollars even. So definitely they will have better research than us. So the whole idea is, can we tap on people or these large hedge funds? Can we tap on people like Warren Buffett to our advantage? How can we leverage on Warren Buffett? So just imagine Warren Buffett doing your investing research for you, finding good companies for you. Does that give you a sense of security or sense of confidence if Warren Buffett himself or big hedge fund managers like him also invest in the companies that you are buying or looking at? Definitely, right? So this is reason number one. And reason number two is that these large hedge funds, they will obviously have a lot of money, right? We're talking about not just billions, but trillions of dollars. And the companies that they're looking at, for example, if Warren Buffett is looking at Apple, and Apple share price right now, let's say example, is at $200. Warren Buffett will not be wanting to buy Apple share price at a price of $200. He might be looking to make his entry at a discount because people like Warren Buffett, they will want to buy these companies at a substantial discount, right? So let's say you want to buy it at a 10% discount of $180, right? So when these large hedge funds, they will be waiting for a certain kind of a market correction before entering to buy it at a cheaper price. Does that make sense? So there's this thing called the $1 trillion safety net. What do I mean by that? So these large hedge funds, right, they obviously have a lot of money, much more than $1 trillion. $1 trillion is only the what we call their spare cash. So when at any point of time, right, these large hedge funds, they will have new investors, retail investors giving them money that they at this point of time they cannot invest into the market, right? So they will accumulate. So this very small accumulation every few months or every quarter, right, will amount to more than $1 trillion already. So can you imagine when the market start to correct and these large hedge funds, they start to pump their money in buying to this company at discount, right? $1 trillion entering to this company. What will happen? So when this money enter, right, what will happen to the companies like, for example, Apple? Their share price will form a support and they will tend to rebound back up, right? So there is a second kind of I will call it a safety net support of or safety net when these large hedge funds when they put their money in. So as a general guide, right, I want to find companies or the companies that I look for, right. Ideally, the companies that I'm looking at or that I want to invest in personally myself, I want it to have a high percentage of institutional ownership. So usually I'm aiming for at least 70%. 70% of institutional ownership is good. So what do I mean by 70%? So that means that let's say Apple share price, right? If more than 70% of their shares is owned by different hedge funds, right, it probably shows that this company is very good because all these large hedge funds, which as I the reasons I mentioned earlier, they have better research, do their research on data analysis better, right? And they think it's a good company and they are putting their money into these companies, right? So I'm looking for at least 70% institutional ownership. And if I can find higher, obviously the higher the better lah. So if I can find more than 85% ownership, that will be very good already. Having said all this, right, having a low institutional ownership of let's say less than 70% does not mean that the company that you're looking at might not be good. It might just be like it might be a good company, but just that these fund managers did not invest in it. especially if the company you are looking at is you have a smaller market capitalization. That means sometimes the company is too small, because this, you must understand that these hedge funds, they have a lot of money, and they can usually only invest in very very big company like Microsoft, Apple, Google, Amazon. Because smaller companies, if their market cap is too small, these hedge funds, they cannot allocate money to it, because like they just allocate 1% of their funds in, right? They can buy over the whole company already. You know what I mean? So smaller companies might not make sense to them. So if you are looking at, so as a disclaimer, if you are looking at a company and you think that is pretty good, but how come the institutional ownership is like very little? Does not mean that it's not a good company, especially if it's a smaller company. So up next, right, I'll be sharing with you how can you find the institutional ownership percentage for the company that you're looking at. So I will go to this website called Finviz. You can just type in finviz.com over here. And Finviz is a financial website where you can screen for different companies, right? So the company that you're looking at, let's say in my example, let's say I just use Visa as an example. So you just click on Visa at the search button there, and as you scroll down here, okay, so there's a pop-up, you can click on it to exit it, right? And you can scroll down here, there are some numbers. So the institutional ownership is shown right here, right? Institutional ownership is shown in short form lah. Okay, but you can see the percentage here is for Visa is about 96.5%. So I think that's pretty good. That's quite exceptional actually. So again, to summarize, the percentage you're looking for institutional ownership is about, generally I like to find it to be obviously the higher better, the higher the better, and I like it to be about at least 70 to 80%. If it can be like above 80 or 85%, it will be better lah, in my opinion. And I use institutional ownership as a form of safety nets to find the companies I'm looking at. And if the company I'm finding is quite a big cap company, quite a large market capitalization, and if its institutional ownership is less than perhaps 60% or so, then I need to ask myself why. What is it that I'm looking for in this company that the other large hedge funds, that people smarter than me, more hardworking than me, like Warren Buffett, what do they not see in the company? Because if people like him did not invest in a company, there might be a reason, right? So these are something to think about. So I've come to the end of this short video. I hope you guys enjoyed the video and learned something, right, to help in your investing journey. So if there's any questions, feel free to comment or ask me about it, yeah? So until next time, see ya.